In the world of finance, when the bulls are out, it's like a rodeo. Wild, unpredictable, and thrilling. Similar to the unbridled raw energy of a cowboy trying to tame a raging bull, the financial world pulses with a similar vigor when the bull market is out. The question invariably arises, what exactly is a bull market? If you were to imagine the spectacle of a bull, powerful and relentless, charging headlong with no intention of stopping, you'd have something akin to a bull market. It signifies a financial scenario where the sun is shining bright on the economic front, and the prices of stocks and commodities are either climbing or anticipated to ascend. This widespread surge in prices can pertain to anything from stocks, bonds, and real estate to currencies and commodities. A bull market is the embodiment of hope, investor faith, and the anticipation of continued stellar outcomes. However, a bull market doesn't just happen overnight. It tends to unfold over an extended period. It's not a furious dash to the finish line, but more of a sustained marathon. The goalpost keeps shifting further, but the runners, or in this case the investors, are more than happy to keep up the pace. As we speak, the US market is flexing its muscles, showing all the robust signs of a bull market. The S&P 500, a prominent barometer of the financial world that gauges the performance of 500 large companies listed on stock exchanges in the United States, is reaching for stars. Think of it as the star quarterback of the finance world, scoring victory after victory. Bull markets often come into play when the economy is gaining momentum or has already established its strength, accompanied by a robust GDP, low unemployment rates, and mounting corporate profits. It's like this vibrant, all-inclusive party where the music tempo is always on the upswing. However, it's important to remember that as the music crescendos, the dance floor can get quite cramped. During a bull market, the appeal of stocks multiplies, culminating in higher trade volumes, increased security valuations, improved liquidity, and a spike in IPO activity. It's the stock market's equivalent of a spontaneous flash mob. Everyone wants a piece of the action. So, what does this mean for you? It's like being at a buffet where both the steaks and the stakes are elevated. Delicious, isn't it? You might be wondering, why are we in a bull market? Well, it's not because Wall Street is teeming with herds of wild bulls. Although that spectacle would be a sight to behold, wouldn't it? Now let's delve into why we've landed in this economic jubilee, as some might term it. Picture the economy as a colossal, finely tuned machine. When all elements of this machine are functioning effectively, we witness a sturdy economy. That's when the gross domestic product, or GDP as it's better known, exhibits robustness, signifying that the country's overall financial well-being is fit and thriving. But the economic enjoyment doesn't halt there. A rate of unemployment is yet another decisive element. When a greater number of individuals are gainfully employed, increased monetary resources are circulated, thereby bolstering the economy. It's comparable to adding kindling to a bonfire, or should we say, the ongoing celebration. Now let's shift our attention to the real heroes of the story, the corporations. When these entities flourish profitably, they play a crucial part in fostering a bull market. Escalating corporate profits signify that companies possess greater capital to invest in hiring and expansion activities. It's akin to the moment when the DJ at the party spins your most loved track, and suddenly the atmosphere just escalates to a whole new level of enjoyment. The last and arguably the most pivotal factor is investor confidence. When investors harbor an optimistic outlook and anticipate the market to persist in its prosperous trajectory, they are more inclined to invest a larger amount. It's analogous to a party where everyone is having a blast, inducing more individuals to partake in the fun, correct? So these elements collectively facilitate a bull market, transforming the economy into an extravagant celebration where the optimism is contagious and cascades like a boundless waterfall. However, one should not forget to exercise caution. Just like any dazzling party, a bull market too has its culmination point. The music eventually ceases, the lights are switched on, and attendees must depart. It's fundamentally the law of nature. What ascends must ultimately descend. Hence, while you're engrossed in the festivity, it's equally vital to keep a watchful eye on the exit. After all, you wouldn't want to be the last one to evacuate, would you? So in essence, a bull market is like a party where everyone is feeling good and the money is flowing. Just remember, what goes up must come down. Gravity, am I right? Alright, so we're in a bull market, but how do you ride this bull without getting thrown off and trampled? Well, it's simpler than you might think. Let's picture the bull market as a wave, a grand, forceful financial wave. Just like any seasoned surfer, you aspire to ride this wave for maximum gain. The time-tested method is buying early and selling at the pinnacle. This is the renowned buy low, sell high strategy. It's been around for ages and is a dependable approach. However, timing the market can be as challenging as forecasting the weather weeks in advance. Here's an alternative strategy: buying during a dip or retracement. A retracement is a brief price movement against the primary trend. Simplified, it's a temporary decline in an upward moving market. Picture this scenario. You're surfing this financial wave and you spot a dip. Rather than panicking and jumping ship, you seize this chance to purchase more at a reduced rate. Then, as the wave resumes its ascent, you're in a more advantageous position than before. These strategies aren't bulletproof. There are no guarantees in investing, but they are tools you can employ to better maneuver the bull market. It's worth noting that the aim isn't to foresee every market fluctuation. That would be as impossible as predicting every ripple in a vast ocean. The goal is to ride the wave, capitalizing on the highs and minimizing the lows. Prepare your investment board, equip yourself with financial knowledge, and get set to ride this bull market wave. However, just as in surfing, understand when it's time to dismount before the wave crashes. Being caught in the crash is worse than missing a wave. Always remember, navigating the bull market is akin to surfing. You need to catch the right wave and know when to disembark before it crashes. So you've got your surfboard, you're ready to catch the wave, but what's your strategy? And no, hoping for the best isn't a strategy. In this financial rodeo, jumping on the bull is simply the start. The real challenge is knowing how to ride it. There are various strategies one can adopt when treading the financial waters. A popular method is the buy and hold approach, a generally low-risk strategy. Here, you invest in a promising stock and sit back, waiting for the bull to carry it upward. However, it is not for those seeking immediate returns. Patience is a virtue in this game. Then there's the increased buy and hold strategy. This method involves gradually investing more as the market rises. It's a step up from the buy and hold approach, requiring a bit more attention and calculation, yet it can potentially provide larger rewards. For the thrill seekers among you, you might consider buying the dip during retracements. This strategy is akin to catching the bull by the horns during a brief stumble, only to ride it back up again. It's risky indeed, but fortune often favors the bold. Alternatively, you could be a full swing trader, ever ready to jump on and off the bull as it bucks and kicks, capitalizing on every rise and fall. This strategy necessitates constant vigilance and a knack for predicting market movements. The point is, each strategy has its own unique set of risks and rewards. What works for one investor might be disastrous for another. This game is about understanding your financial goals, your risk tolerance, and yes, your nerves of steel. So what's your game plan? Are you the buy and hold type, the full swing trader, or do you fall somewhere in between? Are you willing to ride the bull all the way, or are you biding your time, waiting for the ideal moment to dismount? With the bull market in full swing, how are you planning to navigate its waters? Are you contemplating altering your investment strategy, or are you sticking to your tried and true methods? We're eager to hear your thoughts, strategies, and advice. And remember, wisdom lies in sharing. If you've got any insightful tips or sage advice for other investors, don't keep it to yourself. Share it. So go on then, share your bull market strategy in the comments. And remember, there are no wrong answers, only expensive mistakes. And while you're at it, why not like, share, and subscribe to the Investor's Ledger? After all, we're all in this rodeo together.